Welcome to Bloomberg ETF IQ. I'm Katie Greifeld.
And I'm Matt Miller, and I am excited that we get to spend some time with the Bond King today.
30 whole minutes with the Bond King. It's going to be a great show.
Let's get to the biggest stories right now in the more than $10 trillion global ETF industry. Have I mentioned that we have a wide-ranging interview planned with former Pimco founder Bill Gross, or I guess he's still the Pimco founder, right? We're going to talk with the Bond King in just a moment for a whole half hour.
And one of the things we're going to discuss is the turmoil in the bank sector and whether Gross is still confident in those regional banks.
We're also going to speak about the other hot issues, including the U.S. debt ceiling, the possibility of the 14th Amendment being used, and the Fed's fight against inflation. How's it going?
It's difficult, to say the least. But as always, Matt, we have Eric Balchunas from Bloomberg Intelligence with us now, taking a look at the flows. Eric, what do you got?
Matt, Katie, thank you. I got good news in the flows. Finally seeing some flows into equity ETFs. SPY and the Qs at the top of the leaderboard. That tells you a lot of the hot money. The trading crowd is interested right now. Those two tickers haven't really been at the top in a while. It's been a lot of cash-like ETFs and money market funds. You also have in here, interesting, KRE, the regional bank ETF, taking in money. It's come down a little bit lately, but still getting some bids there. And then GLD. GLD was near all-time highs, having a good quarter, but hadn't seen inflows. Finally getting a little love for gold. Let's look at the outflows here. Now, you do see XLF at the top, right? That's a financial sector ETF. So perhaps that is some fear from the banks. IWM small cap, same thing. But then you've got 2 or 3 treasuries up there. Again, generally speaking, money out of treasuries, fixed income, into equities, which we haven't seen in a while. Now, let's look at KRE a little bit more closely. This has been sort of in the middle of the storm, and this ETF's been used by a lot of different people. Here's the price, right? So it's come down about 10% in the last month. It's taken in about $2 billion. I think most of it's long, could be some create to lend in there. But look at the volume. I mean, it was basically asleep until this happened. Anytime you have a crisis, you will generally see ETF volume go up. People come and look to the liquidity for this. So, Matt, Katie, KRE, bank stocks, kind of the center of the financial universe right now.
Yeah, absolutely. It's an issue that doesn't go away, and there's been a lot of volatility in the sector. Let's talk about this right now with Bill Gross, co-founder of Pimco, joins us right now. Bill, we're really grateful to have you with us. Thanks so much for your time today. I want to start on KRE and the regional banks. I read one of your investing letters recently, and you talked about how you're like becoming a bank owner, basically, through investment in these regional banks. How's it going with that?
Well, it's obviously going up and down. The last few days, they've bounced back up. The question is whether this is a crisis of interest rates, higher interest rates, or simply a crisis of contagion where investors fear the worst. And, those are difficult situations to value and to buy or sell. But I think, based on KRE, which is an ETF and has about 150 different issues, most of them less than 1% in terms of the weighting, but based upon that, I think we've stabilized to some extent. The values are there. The price-to-book ratios are about 0.6 on average, whereas they used to be on the regionals about 1.1. And so, we've got a situation where there's value, but we've also got a situation where investors are still leery based upon deposits and the lack of deposits.
And so talk to us why then we're talking about an ETF. Obviously, if you look at the regional bank landscape as a whole, there's been some specific names that have really seen the brunt of the action. PacWest in particular over the past week has been extremely volatile. So if you're looking at this situation evolving, does it make more sense to go into something like KRE that tracks all of these names versus trying to pick one?
Well, I think for the conservative investor, it does. The diversification is a positive, and KRE is not as volatile as some of the ones that you mentioned. That's not what I've done. As a matter of fact, I think buying the stocks or shorting the stocks is really not the way to go from here. I think what you want to do is sell the volatility in this particular sector. The volatility on many of these stocks is extraordinary. On PacWest, it's 300 normalized, which I know is technical, but is extremely high volatility, and it's the same thing on many other stocks. I've been selling volatility on Western Alliance, it's WLAL, and on Zion. Both of those volatilities are much higher than normal, higher than 100. And, you know, should the market simply stabilize, which is what I'm talking about, what I'm thinking at these lower levels, then a 2-week or a month-and-a-half option, what I call a strangle, you know, selling a put, selling a call at 10% above and 10% below, you know, they provide a very, very potentially profitable investment as opposed to simply buying the stock or selling the stock.
And Bill, when you talk about rates and banks, right, we've been tracking this chart all year of the yield on money market mutual funds, and it's just sort of blossomed. It's almost 5%, right, with the stable dollar NAV, whereas savings deposit rates have been pretty much lower. How much of a threat is all this money going to money market funds for banks? Could this be another headwind for that sector?
Well, I think it is. Many of them have suggested that it's stabilized. I mean, Western Alliance 2 weeks ago suggested that deposits were moving up as opposed to down. And we know about potential problems with Schwab because they have a bank as opposed to a money market fund type of situation. And their margins obviously will be pressured going forward, but not threatening from the standpoint of bankruptcy. I think, yeah, to the extent that money moves out of the regional banks and they lose deposits, it's certainly a negative, as is, you know, of course, the state of the economy going forward to the extent that regionals lend less, and they're a big factor here. To the extent that they lend less, then it slows the economy down. And, you know, coincidentally, slowing the economy down has lowered interest rates and has reduced the duration risk on many of these regional banks, not significantly, but at least to some extent.
Well, it's a problem. I mean, slowing the nominal GDP growth down is a real problem when you're paying interest on a $30 trillion worth of debt. I wonder your take on that, Bill, and also, you know, in terms of the regional bank blowup, we saw 4 banks fail in America in the last 2 months. Whose fault is it? What can we do to change that? How can we fix this?
Well, the policymakers have tried to fix it with another quick fix. I think it's justified in the short term, but to the extent that in one of the situations or 2 of the situations in the past few weeks, they've guaranteed all deposits as opposed to simply the FDIC ones. And so, you know, we have policy problems, but the Fed and policymakers are there to try and support the situation, but it's not a long-term fix. It's a long-term negative going forward. And you talked about GDP. I missed that question there.
I was just saying, like, you know, people are telling me it's not a big problem that we have now $31.5 trillion in debt. As long as we have, you know, GDP growth of nominal growth of 7%, it's okay since the average weighted cost of that debt is only 2.5%. But it seems to me if you slow down the growth, it's going to be a real problem in terms of dealing with the interest payments.
I agree exactly, and I don't like that phrase because everybody seems to agree with everybody on you know, financial shows. But in any case, you know, the Economist came out with an interesting article last week in their current edition, and they suggested, according to I think rather reasonable projections, that that the deficit, the U.S. deficit, by the end of the decade will average about 7% going forward, as opposed to, you know, what we've seen 3 or 4% or a little bit higher in the pandemic. A 7% deficit going forward is not a sustainable type of deficit unless the government prints money and unless the fiscal side of the government continues to pump out money in terms of you know, deficit spending. So this is not a positive situation, but it's a longer term one. I remember Pete Peterson of Blackstone Group 20 years ago, and he's a smart guy, talking about the same problem with Social Security and Medicare and health benefits, and that's the real problem going forward. It's something that the market has to address as we move along, but perhaps not today.
Well, Bill, just really quickly, and you're sticking with us, but before we go to break, I am curious to hear your thoughts on the debt ceiling, because we are barreling down to that X date. What's your best guess as to how this all plays out?
Well, I think it's ridiculous. It's always resolved, and not that it's a 100% chance, but I think it gets resolved. The problem in the past has resulted in, Treasury bill rates close to the point of potential default, moving higher by 50 or 100 basis points, and they've done that this time. So I would suggest for those that are less concerned, similar to myself, that they buy a 1 month, 2 month Treasury bill at a much higher rate than they get with a longer term Treasury bill.
All right, excellent. We're going to continue to talk with you. Bill's going to stick with us. Bill Gross, coming up on the program, we're going to get his thoughts on inflation and what the Fed's next move will be next. This is ETF IQ on Bloomberg.
Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF world, rather. And we start with Vcash. Of course, this is the Vanguard short-term corporate bond ETF. And this really caught my eye because Vanguard funds just tend to take in money no matter what circumstance. But Vcash is on track for 14 straight weeks of outflows. Very rare to see with a Vanguard product, so definitely one we're going to keep an eye on. Let's also talk about preferreds, because they're a funky type of security, kind of a mix between equity and debt. You're looking at PFF here, and last week was really difficult. It lost about 5% last week. That was its worst performance in a long time, as you can see, back to 2020. So this is interesting because banks tend to issue preferreds. That's the market that they tend to play in, and it's obviously been a weird time for the banks. Let's also talk about inflation, though, and let's talk specifically about tips, because you're looking at S-tip here versus a straight-up Treasury fund that tracks 3 to 7 year debt. S-tip is 0 to 5 years. So a little bit of apples to oranges, but same sort of deal. As you can see, they're pretty much dead on when it comes to performance. And this was interesting to me, Matt, because actually in Bill Gross's latest investment outlook, he said that own tips through ETFs such as S-tip, because inflation is going to remain a problem from here.
Yeah, and let's get to Bill Gross and talk a little bit about that right now. He is of course, co-founder of Pimco. He joins us on this program for half hour. Delighted to have you back, Bill. Let me ask why ETFs, because you do mention S-tip and V-tip, are ways to own tips as a way to, beat the inflation that we're seeing as an investor. Why the ETF wrapper?
Well, I've owned both, Matt, and strange enough, the liquidity in the government tip market from 2 to 10 to 30 years is not what it is in terms of V-tip or S-tip, which are much shorter securities, and as you mentioned, ETFs. Now, that doesn't take into consideration the potential discount or the potential premium that you pay to get in, but I've found that it's much easier to get in and out on these ETFs than it is to get in and out on, a 2 to 10 year tip. The spread on a 2 to year tip is something like 8 to 12, 30 seconds, and it's pretty much wider than historical circumstances. So a small investor's advantage, and the expenses on these two particular ETFs are very low, and it's a good idea for an investor that believes in inflation.
Yeah, Bill, and obviously I agree with you. I'm an ETF analyst. The liquidity is there. But over the past decade, as you know, there's always been this sort of occasional worry that there's a liquidity mismatch, maybe not in the tips, but maybe in like a junk bond ETF. What do you think of those worries? Is there any validity to them, or is it just something that we should not worry about, even in a crisis situation?
No, I think there is not in the inflation-protected area, but I think in the high-yield area, certainly there will be. I mean, up until this point, the high-yield indices and some of the high-yield ETFs have held up relatively well compared to what I would have expected. I think that's probably because the economy has held up relatively well, 2 to 3 to 4%, and still above the line. But you know, should we move down towards the recessionary 0 and lower, then it's you know, certainly a situation where some of the triple C's and even double B's come under pressure. And so I wouldn't be investing in high-yield bonds or high-yield ETFs. I'd simply be looking for safer havens, and I've got a few.
Well, talk to us a little bit about some of those safer havens. We've talked about tips, for example. You're staying away from junk. Where else are you looking, though?
Well, my strongest feeling and my highest percentage holding, maybe 30% of the portfolio, are in are in oil pipelines that are partnerships. Therefore, they have taxes that are deferred until you sell them, and for an average holding period of about 5 years, that adds 2 or 3% to the adjusted yield, so to speak, to the pre-tax yield. And many of these ETFs are yielding 10, 11, 12%. The premier ETF, the largest and the premier in terms of quality, in my opinion, you know, is Energy Transfer. It's ET by symbol. It yields 10%. You know, is it dependent upon oil prices? Not too much, because it's close to its peak, and oil is not close to its peak. You know, it's dependent upon take-or-pay type of contracts. It's all over the country. It's a big liquid issue, and if you want 10% tax deferred in a partnership, if you're prepared to fill out the tax form, then fine, I'll take 10%, which is really a 12 or 13% pre-tax equivalent.
Bill, I'm turning 50 in November, and in my lifetime, we've averaged about 4% inflation every year. Before that, my grandfather's generation had the last 50 years an average 1.7%. Is there any chance that we can get back to that, or should we forget it?
Gosh, Matt, those are my numbers. I just punched them out on Bloomberg about an hour ago. And, you're right on in terms of historical levels and the recent levels. Is there any chance? I don't think there's much of a chance to get back to 2% absent a severe deflation, which I don't see at the moment. I think policymakers come to the rescue. But it's a 3 to 4% environment going forward for me. The problem is that we have substantial deficits, and as mentioned before, the deficits probably increase year by year as we move along the decade. The problem also is that you know, the Fed is still providing substantial liquidity to the markets. Yes, real interest rates are high, but it's going to be a hard slog to move back down to 2%. I think Powell knows it. They talk it. But I think 3% is an objective goal going forward.
Should 2%, though, still be the goal, regardless of how long it might take to get there? And just looking at the data, looks like it's going to be longer than thought. Should the Fed really be married to this 2% target?
Well, not yet, because we're moving down closer to it. You know, the minute we get to 3 and bounce back up to 4, if that's the hypothetical, then you know, that's when the Fed worries. I think they've got a lot of things going forward for them at the moment. They've got the CRB index, which is down 15% from the peak, as opposed to nearly up 50% in the prior period of time. And so commodities themselves are deflationary. It's wages and labor that you know, present the problem. And to the extent that you know, some of the indexes and indices and thirsty types of numbers in terms of jobs, you know, we're moving back up in a direction which would lower wages. But you've got to get wages, as Powell would probably agree, you've got to get wages down to about 3% on average, because productivity, when you take productivity out of wages, at 1 to 1.5% produces that 2% level. But we're far from 3% on wages. We're up at 5.5%, and we're going to have to see some progress there.
So, Bill, I'd like to shift gears a little bit to about a decade ago when you launched Bond. It was really the first big hit active ETF on the market. I think after GLD, it was the fastest to get to $1 billion, had a nice run. It's now over a decade old. Bond managers have survived the passive wave better than stock pickers. And yes, active ETFs are starting to get some flows. And I just want to get your advice to a retail investor who is shopping for an active bond ETF. What should they look for?
Well, they should look for some balance, and they should look for some risk that I guess mimics the bond market itself, absent high yield. Bonds themselves over the past 12 to 18 months have gone against the old 60-40 premise where you should have a certain percentage in bonds, a certain percentage in stocks, and that would balance out and produce a positive type of return going forward. That hasn't happened now, of course, because we started, in terms of yields, we started with 10-year bonds, less than 1%, and now they're at close to 3.5%, and so there's been some substantial losses. I simply think that a bond ETF is a good holding, but not a holding that can produce 5 to 10% going forward. They yield 3.5 to 4%, and absent any significant change in 10-year yields, then that's what you're about to get.
Bill, we have a question from the audience, so I'd love to hear your take on artificial intelligence. The audience, an audience member wants to know, can we ask Bill Gross what he thinks about AI picking stocks while we're talking about active ETFs? What do you think about the AI investment angle? Can AI eventually pick stocks better than a fund manager or a monkey throwing darts?
Well, I've tried that over the last few weeks, and it, the problem with AI picking stocks at the moment, in terms of my in terms of my chat PT, they're pretty non-committal. Perhaps going forward, they'll be able to blend in, technical analysis and value and those types of things, but I haven't seen it yet. I think AI is interesting. Obviously, I'm into it in a minimal way, but at least I have the ability to access it, on a morning-to-morning basis. I think also the important thing on AI for the economy is that it's very deflationary, to the extent that it leads to, layoffs in any workforce, and we can name 5, 10, 15, 20 industries where it probably will, then that reduces the pressure in terms of labor, reduces wage gains going forward. But that's a 1 to 2 to 3 year concept going forward. I think it pays to watch it, though.
All right, Bill, great spending time with you. Thanks so much for joining us. Really appreciate it. Pimco co-founder Bill Gross, the Bond King. Always a pleasure to get your insight, and I think a lot of people tuned in and turned on, paying attention to that. So he uses AI, it seems, on a morning-to-morning basis. I'd love to see what Bill Gross's Chat GPT looks like.
I don't even use AI, though. I haven't fiddled that much with Chat GPT. I thought the comments, though, on the debt ceiling, to go back to 20 minutes ago, that recommendation that, okay, it's probably going to be okay, maybe 1 to 2 month T-bills look good here. We've obviously seen some big dislocations in that market, so between AI and T-bills, it was wide-ranging. That's what we promised.
And how about, I think he said this, 30% of his portfolio is in MLPs.
There you go.
That's a shocker. I mean, that's a real small neck of the ETF universe, but yeah, big yields over there. But that tax form is a killer. He even mentioned it.
That's a big piece of news. I think you got to get Athanasios Sarafagis writing that one up right away. Great, anyway, to spend some time with Bill Gross. And, of course, you can watch that again and again on Bloomberg.com. Also, if you're into ETFs, you can listen to Eric and Joel. They have their own podcast, Trillions. It's their bi-weekly podcast covering the industry. That does it for Bloomberg ETF IQ. This is Bloomberg.